Another question that came up on stage was just Bill Gross and his outlook for where things are headed. There's an article in today's Wall Street Journal that talks about Bill Gross and other people who have been very bearish on bonds. Your take on what Bill Gross has been pointing out on this is what?
Well, I don't know the exact specific comments. In terms of bonds, someday they will sell the yield a whole lot more than they're yielding now. I don't know when it'll happen.
So you agree with him on that point?
Oh, it has. It's going to happen. And the question well, the question is always when. I'm no good on that. And the question is to what degree it happens. But you could have interest rates very significantly different than what they are now in some reasonable period in the future. It's not a game that I can play. I mean, I don't have any special insight into that sort of thing other than that it will happen. In terms of stocks, stocks are reasonably priced. They were very cheap a few years ago. They're reasonably priced now. But stocks grow in value over time because they retain earnings and they expand basically the companies underneath. So, I like owning stocks. I do not like owning bonds now. There could be conditions under which we would own bonds, but they're conditions far different than what exists now.
Well, it's always been standard investment advice that you have some sort of a blend of stocks and bonds so that you keep things just for the man on the street, I should say, for the average investor who is kind of looking at this, getting a little bit of advice. Joe went in not long ago and talked to a retirement specialist who told him he should be 40% in bonds. I just wonder if this is a very different time.
No, you shouldn't be 40% in bonds. My family, anybody that I've advised, and a lot of them are just typical people. I mean, they're not super wealthy or anything of the sort. And bear in mind they have the proper attitude in that if stocks go down 20% in the next month, they're not going to be bothered. But I would have them having enough cash on hand so they feel comfortable, and then the rest in equities. Or if they, if they're farmers they could own apartment houses or other things. But I would have productive assets. I would favor those enormously over fixed dollar investments now. And I think it's silly to have some ratio like 30 or 40 or 50% in bonds. They're terrible investments now.
So now, this is not just your lifelong look on it. This is particularly tuned to what's happening right now.
I bought bonds back in the early 80s. We made a lot of money, and we bought zero coupon bonds. And I bought them personally. And the price of everything determines its attractiveness. And when the price of stocks was way down a few years ago, the news was terrible, but stocks were cheap. News is better now. Stocks are higher. They're not ridiculously high at all. And bonds are priced artificially. You've got some guy buying $85 billion a month. And that will change at some point. And when it changes, people could lose a lot of money if they're in long-term bonds.
Lee Cooperman's point when he talked to us about it was that this is kind of like bending down to pick up a quarter in front of a steamroller.
Yeah, well, I'm not sure it's even a quarter.
Yeah, so it is a concern for you. If you look at the pension funds, though, a lot of them are being forced out into other places to try and seek yield because they've promised or they're expected to return around 8% a year or something just to meet their obligations. It's a much more difficult game.
Yeah, chasing yield is crazy. Just because you'd like to earn 8% or you'd like to earn 10% or you'd like to earn 6%, the world isn't going to adapt to that. You have to think about what is the most intelligent thing to do, and if that produces 5% or 6%, that's the best you're going to do. But to get enticed into some investment that is risky or that you don't understand because somebody promises you a higher yield, I mean, I can take you down to the waterfront or something like that, and they'll promise you 15% or something. It just doesn't make any sense at all. But pension funds, they haven't been that well managed over time.
We spoke with the CEO of Lloyd's of London last week and talked to him about some of the insurance businesses, and he said he's a little worried about hot money getting into the insurance arena because he thinks it could very likely create a bubble there. He's not saying that it's happened yet, but he says as you see hedge fund managers and others who are looking for yield, they look at insurance stocks and it seems like potentially a good place to put that. But he's worried about that being fast money that is in the market and back out, and that's not good, he thinks.
Well, money is capacity in terms of insurance. I mean, you need to have money to get people to trust you to write insurance policies that you'll pay off. So when you bring more money in, it's just like bringing in more capacity, and it's just like bringing in more steel capacity or auto capacity. it's likely to affect the supply side of the equation. And if the demand side doesn't change, prices come down. So he's correct in that. And of course, a number of money managers, they talk about, something is uncorrelated, other things. They'll sell what they can sell. So it's very attractive for the money manager to create it. And then the question is whether it's attractive for the investor when the game is all done.